Hey guys, welcome to the webinar. The presentation will be approximately 40 minutes with a live Q&A afterwards, where Eric will answer as many questions as he can, as time permits. Any questions I can't get to in the allotted time, we will follow up with offline. I encourage you to ask any questions you have throughout the presentation. I will be moderating the chat throughout the presentation. To get to the chat, just move your mouse slightly if you're on desktop or laptop, and you will see a menu bar pop up on the bottom. If you're on tablet or smartphone, just simply tap on the middle of your screen. If you can now just click on the chat icon and type something, your favorite car, for instance, and hit send so I can see everyone's able to use that chat. I see a few in there. I see David and Norma and Jeff, Mark. I see Brian in there. Favorite car is a Tesla. I like a WRX. That's what I want. Don't have it yet though.
13 people trying.
Okay. Let me see. All right, guys, don't be afraid to ask any questions. The presentation is going to start now. So if any questions you can't be answered, either I myself or Eric will be able to talk to them afterwards. Or, anyways, here's what?
Or we'll follow up with you.
Yeah, we'll follow up with you for sure. Forgive me, this is my first time doing this, but here, guys, this is Eric. He's ready to go over the webinar with you. Take it away, Eric.
Am I live here? Everybody see my video? So thanks, Brennan, for the intro. So how's everybody doing this morning? Welcome. I'm glad you're here. This has been put together, hopefully, to help you guys to and through a stress-free retirement. Usually I do these live in colleges throughout the Tampa Bay area, and we usually pack the rooms with like 60 folks. And so this is new for us. This is our first live webinar that we're doing here. So we're learning as hopefully you guys are learning. So let's have fun with this. We're going to have a ton of information to go through today, probably about 55 slides or so. And I hope to get through it in 30 to 45 minutes. And then, like Brennan said, we'll try to get to some questions if we can. If we can't get to your questions, we will certainly follow up with you immediately and try to get your specific questions answered. I'm sure you're going to have a lot of questions. So hopefully you got a pen and paper handy and you're going to be paying close attention. I do believe that this presentation will be very, very impactful for you folks. So new challenges in 2020. It's been a crazy year, right? COVID-19, we're dealing with COVID and this pandemic. And so it's changed things. It's been an up and down year. It's been quite volatile. And I'm sure retirees and even pre-retirees that are out there are looking for answers and kind of scared and maybe don't know exactly what to do to move forward. And not a lot has changed for us in the way that we help folks. However, with COVID, it does create some more challenges. So let's get into it. With that being said, a little bit about myself. So everybody, there's a lot of advisors who come together and we put this presentation together. And there's a bunch of us throughout the country that are giving these presentations. And so, we've adapted what we're doing for COVID-19 and offering these webinars. So one thing, with these Zoom meetings, they can be a little weird, but hopefully we can get some questions answered for you guys. But I've been in the business over 22 years here in the Tampa Bay area. We cover all of Tampa Bay. We can come to you via Zoom, we can come to you over the phone, or we can have a meeting in one of our local offices close to you. I've been in the business 22 years. I'm a disabled combat veteran. Been helping folks. I've written my own book, What is Your Financial Speed? Written for Forbes, Fortune. So most of the guys that are giving these presentations throughout the country today have been around for quite a while. And this is just a new way for us to help folks out, okay? Why do I do what I do? Just a kind of a fun picture. That's my family, my wife and my 4 children. One of my very special children's up there in the far right. That's my dog, Sammy. And we love to fish. And you can see she's kind of hunting those redfish for me. And then also disabled combat vet, did 6 years active duty, 3 combat tours. Big shout out to my veterans. If you guys are out there, give us a little chat. Let us know what you served, what branch you served in, and who you and when you served. I love to hear that kind of stuff. But why do I do what I do? I absolutely love what I do. I'm super passionate about it. This is why. I have an awesome family. And also, I just throughout the years have seen a lot of mistakes that retirees are making, and potentially getting out in front of that and helping folks build and grow a stress-free retirement just kind of gives me a lot of passion. And so there's a lot of mistakes being made out there. The number one thing that we want to do today, folks, is really kind of stress upon 3 key things. When we're helping folks and we're teaching folks and educating them, there's 3 things that we're focusing on. And I hope that comes out in the slide presentation today is, we want to reduce fees. We want to reduce taxes. Those are the silent killers on your retirement. So we want to reduce fees, we want to reduce taxes, and we also want to reduce risk. So many people out there are taking on too much risk these days, and a lot of folks don't even know what kind of risk they have in their portfolio. So if we can address those 3 things, we can drastically reduce the silent killers and the drag on your portfolio and increase your earnings over time, as well as, give you that stress-free retirement that we're looking to build for you. Okay. So let's kind of jump into it. Obviously, COVID-19 has deeply impacted our economy. We've had some extremely unprecedented unemployment, right? The S&P 500, which is the stock market's been pretty volatile up and down. And referring back to 2008 and 2009, we saw the S&P, the stock market, lose over 50%, right? And so that might not have been as impactful or as important to you 10 years ago. However, now as you're getting close to retirement, or maybe you're already in retirement and you're having to start thinking about drawing money, think about if we go through some major market corrections and you're drawing money out of your portfolio at the same time, it can be extremely devastating to your long-term results and success, okay? So a lot of crazy stuff going out there. Hopefully the vaccine's coming. Hopefully we don't go into a bunch of lockdowns again. I think that would be extremely problematic for our economy. However, we have strategies for you to where you can put your head on the pillow at night and not have to worry about it. So let's try to kind of get through some of that stuff today. So obviously, just kind of reiterating what we said earlier, probably everybody on this call has been impacted by COVID-19 in some way, shape, or form. And, everybody has probably come in contact with somebody that's been infected. And I think that a couple of things could happen, right? If we go into further lockdowns, it's going to send our economy, I think, deeper into a more dramatic spiral. I don't like that idea at all. As a financial advisor, I think we need to protect the folks that are at risk, but at the same time, the people that are healthy and can work need to keep working to keep driving this economy, okay? So hopefully that's what happens. Hopefully the vaccine comes out and hopefully we continue to improve. We have seen some improvement in the economy. Jobless claims have gotten a little better recently. Manufacturing's back up. The market has been, steadily kind of holding on and hanging in there. But as a retiree or someone close to retirement, we don't really want you guys to have to worry about that stuff, okay? So next slide. So let's talk about kind of what happened here in 2020. The Secure Act was enacted. Okay, the Secure Act went in effect in January 1st of 2020. And this has been like one of the largest changes in retirement law in history. So one thing that it did was it removed the age cap for IRA contributions. Okay, so now you can continue to contribute to your IRA regardless of age. It's also, prior to this, you would have to have had started to take required minimum distributions out of your IRA at 70 and a half, but they've extended that to 72. So that's pretty important, gives you some more time to save and stretch that money out. But it did actually eliminate the stretch IRA for non-spouse beneficiaries. It also passed the CARES Act. So things bounced around back and forth in the Senate. They finally got that passed. I think they're trying to maybe come together, even though we're in a pretty bipartisan climate right now, but they're trying to pass another act of support. But this CARES Act is pretty important for you all out there listening. So it suspended your required minimum distributions for 2020. So you did not have to take those in 2020. In fact, if you did take them, I think you can still return them. It also has eliminated the 10% early withdrawal penalty for those younger than 59 and a half who have been actually impacted by COVID. Also allowed for a distribution of up to $100,000 from your IRA, and you can spread the taxes out and repay that over 3 years. So that's pretty important. And also created a special exception for non-spouse beneficiaries. This is just a little chart that we like to show folks. You know, obviously the markets have been recovering. However, we never know what is going to happen going forward, and no one has a crystal ball. And so predictability is pretty difficult, right? So one thing that we like to do at Take Point Wealth Management is we like to try to help folks create some more predictability. However, this chart just illustrates, once you're coming out of those accumulation years and you're going into those distribution years, and you start taking distributions from your 401ks, your IRAs, your retirement accounts, you really can't suffer market losses at the same time. And in fact, if you do suffer those market losses in the first 5 years of your retirement and you're taking out money, it's pretty devastating, and it can really affect your long-term goals and success. This chart just kind of shows you as an example, if you had $100,000, for instance, and you lost 20% in your portfolio, you're down to 80 grand, right? Well, you actually have to make 25% to get back to where you started. So think about that. If you went down 25, or you went down 20%, and maybe you took 5% as well to live on for the year, now you're down 30%. You've got to make almost 43% return in your portfolio to get back to even. And that's not an easy thing to do, folks. And that can take years to make up if you have some good markets and some good participation. So we really want to stress, as you're getting close to retirement, and then even if you are in retirement, you've really got to look at ways to reducing that risk and that withdrawal effect that can potentially hit your portfolio. It can be pretty devastating. So one of the things that we like to do, like I was talking about earlier, is a checklist to reduce taxes and grow assets, right? So one thing that we do is, just to reiterate, we analyze your portfolio for those risks, those expenses, and their fees, and we try to, get those down, and that's important. We can sometimes eliminate fees completely. We look at your income needs. It's real important to look at monthly expenses, your retirement and income, what kind of Social Security you're going to potentially have. When do you take Social Security? There's several rules there and timeframes that you can take it. But we believe investing in a smart financial plan, following the rule of 100, okay, smart risk and smart safe, with even maybe implementing some fixed index annuities, is really the smart way to go and the smart plan. So this investing in tax-free accounts is huge. We talk about this all the time. I do host a radio show, 99.9 Talk Radio, every Saturday morning. We talked about that this morning. Utilizing the Roth IRA, utilizing index universal life policies to create a tax-free retirement is so important. We're going to talk a little bit about that more later in the presentation. So kind of, keep a close ear for that one. And then following the 4% rule, so you never outlive your money. Most actuaries, economists, prize-winning economists say you really don't want to be taking more than 4% from your portfolio over time, without having a long-term negative impact on that. So some of the things that we kind of pay close attention when we're helping folks plan. So when we do analyze your portfolio or analyze your current plan, whatever it is that you may be doing, it's a pretty in-depth analysis. We offer this completely free for our clients, and folks, and you guys out there listening today are also going to be able to take advantage of that free offer. So we'll take a close look at your portfolio. We'll analyze that for you, and we're going to look at Morningstar. We'll pull a report on there. It's going to look at your portfolio and kind of create an X-ray. We need to understand your average return over the last 10 years. We need to determine your geographic and sector risks and what your benchmark is, right? We'll calculate that expense ratio. A lot of people don't really know what they're paying in expenses. So we'll pull all those hidden expenses out and show you how that's kind of maybe eating away at your portfolio. Bonds, right? Most people have a lot of bonds in their portfolio currently, whether you owned a mutual fund and it has bond exposure. You may not even know it, but let's say you're in a balanced portfolio of 50% stocks, 50% bonds, or you have quite a few bonds in your portfolio. So bonds are carrying quite a bit of risk now today as well. So we want to talk a little bit about that. Most importantly, we're going to assess your income needs, right? So 2 months, we're going to add 2 months total and divide by 2 to learn your true expenses, right? So most people don't even know what their expenses are. They're not keeping track of those. They're not keeping a good budget. The first and foremost thing in retirement planning is we got to know what your budget is. We got to know what your expenses are currently and what they look like in retirement. And so that's the first challenge, is just, really get a grasp of what your budget is. Take a look at what things are going to look like in retirement for you. Are you fishing? Are you traveling? What are you doing with your time and your money? And let's try to really narrow down a budget. That's the most important thing. And then let's talk about, collect and calculate Social Security income, pension income. We're going to see what all your guaranteed sources of income are. We're going to learn how your RMDs work and how that affects your retirement income and withdrawal rates, and try to reinvest and not spend all your RMD each year, right? So really important to take a look at your income needs. I think later on in the presentation, we talk a little bit about your income gap. So let's just say your expenses are $5,000 a month, but you only have $3,000 a month coming in guaranteed income. We've got about $2,000 that we have to make up there somehow, right? And we want those to be kind of guaranteed long-term for your future. Let's talk a little bit about required minimum distribution. So for qualified accounts, that means your IRAs, 401ks, once you reach age 72, you're going to have to start withdrawing money. Uncle Sam wants to start taxing that. And what's interesting is, we're going to talk about whether you feel as though tax rates are going to go up in the future or not. But Uncle Sam is probably licking his chops when he knows that about $60 trillion of market assets are sitting in your all's 401ks and IRAs. So think about that. They know that this big bucket of money sitting there that they can tax, right? So we're going to talk about the deficit and everything else a little bit later, but I definitely think taxes are going to increase. So we got to be mindful of that. So they gave us a little break here. You guys get to start at age 72 instead of age 70. This is just a little example of what a required annual withdrawal would look like. So at age 72, it's approximately around 3.64%. Age 75 for age 80, and you can see age 85, about almost 7% of your portfolio needs to be withdrawn. So, and if you don't keep up with your RMDs or you're missing RMD, there is an RMD penalty of 50%. Okay, so we've got to be careful of that. So one of the things that you know, we have seen this happen in our practice is, you know, is really avoiding that 50% IRS penalty. With proper required minimum distribution planning, we can avoid that, right? Go ahead and, you know, click those links, guys, if you want to schedule a Calendly appointment, so we can help you guys make sure that you're not affected by those RMDs. This is just a required minimum distribution calculator example, just kind of shows you that chart, you know. So if anybody's out there at age 75, you got that factor of 22.9. You can see kind of where your required minimum distributions will start coming out, right? Just an example of a chart there. This is just the RMD factor chart that the IRS uses. Social Security, right? So how much income should I receive or could I receive? This is just an example. You see here, you got kind of the average annual income of 50,000. So at age 62, you're roughly at $1,400 a month. If you waited to age 70, you're going to be about $2,400 a month. So our Social Security goes up, right, every year that we defer it. Everybody out there listening, you've got a full retirement age, probably around 66 in some months or 67. And that full retirement age, you would receive your full benefit. But if you decide not to take that full benefit and defer it, you're going to get an 8% increase every year. So we always kind of tell folks, if you don't need to take it, don't take it. Let's keep growing that thing, because currently has that 8% guarantee, and that's pretty tough to match out there in the real world, right? Social Security benefits, does a longer wait mean more benefits? Absolutely. I just kind of addressed that earlier. So this chart just kind of shows, you know, what it would look like if you did delay those credits, okay? And we can certainly help you guys pull your reports off of SSA.gov. We do a total Social Security maximization analyzer for you guys, whether you're married or not. You know, there's a lot of different ways you can take Social Security, a lot of different strategies, and a lot of different combinations thereof. So keeping mindful that we want to always reduce taxes if we can, and even eliminate taxes on your Social Security if we possibly can. So it's real important to be mindful of those. So if you want to try to maximize every penny of your Social Security paycheck, we can do that Social Security maximization report for you. Perhaps you're listening and you don't really want to do a complete retirement plan. That's fine. We tailor everything for folks out there and what they truly need, but you can go ahead and I think, Brennan, you're going to send that link out to folks so they can just click on it real quick here if they want to make that Calendly appointment.
It's live in the chat right now.
All right. So here's that retirement income gap example, real important, right? So I already kind of jumped ahead. That's how my mind kind of rolls, I guess. But this kind of is just an illustration of what that would look like. So let's say you had some annual non-discretionary expenses of around 61.5, and you had some pension income, you had some Social Security income, you add that all up, and you have a retirement gap of 15,500, right? So we got to try to find ways that we can fill that gap and kind of guarantee that income. Because what's the number one thing nobody wants to do in retirement? It's the number one question that comes back in surveys is we don't want to run out of income, right? We don't want to run out of money. So one of the things that we do, just a little more in depth, is we will actually help you determine that Social Security income available to you during your retirement age, right? We're going to estimate those monthly expenses. We're going to research and estimate inflation. So all that comes into our report. And when we're building out a plan for you guys, we're going to reduce future tax risk by utilizing a Roth IRA conversion or even potentially life insurance. So let's think about that for a second. If you have a Roth and your money's growing tax-free, and then later on in retirement, you can pull it out tax-free, think of how impactful that is for you guys. You know, if our government raises taxes to 80%, it doesn't matter, right? 80% is 0. So that's our real focus, especially now and today with what's going on, is to kind of convert you guys and get you closer to that IRA conversion. And also utilizing whole life policies is an awesome, you know, this is kind of what the wealthy do with their money. You can place your money in a whole life IUL. It'll grow tax-free. You get market-like returns, completely safe. You don't lose a dime. You can pull it out tax-free and even pass it to your heirs tax-free. So pretty impactful stuff. So plan for loss of 33+% in SA income with death of a spouse, right? So if your spouse passes away, you're certainly going to lose their Social Security. We want to follow that 4% rule and stay invested with a smart risk plan and outpace that inflation. Of course, consider that Rule 100 and potential bond and a potential bond replacement strategy. So we can help you generate that personal pension, and we'll show you how. All right, and we recalibrate that every year. This is a moving, this is a moving plan. It's constantly moving and changing, and so we have to adapt. And so you have to revisit this at a minimum annually and make sure things are working for you. So some of you may have heard Rule 72. It's kind of important, right? Rule 72 is just how long would it take for me to double my money? So in this example, if you had an investment of $1 and you had an annual interest rate of 10%, you divide that by 72 and you get 7.2 years, right? So if you have an investment of $10 with an annual fixed interest rate at 10%, you would take approximately 7.2 years to grow to $2. So, even if you are getting, if you build a decent portfolio and kind of look at some of the strategies that we utilize, if we can just even average around 6%, you should be able to double your money over 10 to 12 years, right? And it's important to keep that money moving forward and growing. So what is the future of taxes? So a little participation in the chat here. I would love to see you guys chat in or raise your hand or tell Brennan, how many do you think, how many people out there listening think taxes are actually going to go up in the future, or even in the near future, or in the next 5 to 10 years? You can see based on this chart historically, right? Taxes are on sale right now. So it's a great time to be doing some of these tax strategies, Roth conversion, converting your current IRAs to a Roth, right? We'll talk about some specifics there later on. But if you look at this chart, I mean, taxes are on sale right now. So it's a great time to be kind of looking at that strategy. Historically, 60s and 63, we had the top tax rates as high as 87%, right? So currently, the marginal tax rates have been reduced with the Tax Reform Act that Trump put in place. And so those margins are much lower right now. The CBO.gov estimated future tax rates as high as 88% for the top tax rates, 25% for your lowest. So when they talk about, oh, we're just going to raise taxes on the rich, don't believe it. Taxes will be raised on everybody across the board. And if you think about it, even if they just raise taxes on the rich, what are the rich going to do, right? They're the ones that own the businesses, the companies, the entrepreneurs. They're just going to increase their prices, keep their margins the same. So everybody out there, the consumer, ends up paying for tax increases. So we're all going to pay for the tax increases, but I'm not really as concerned about that as I am for you guys, retirees and people getting close to retirement, is, preserving that retirement the best we can and coming up with the strategies to eliminate that tax is what I'm really concerned for you guys. Okay. So will taxes go up in the future? Let's look at 2020 US tax brackets, right? We can see where the top bracket's 37%. Okay. The low tax rate 10%. I mean, these are extremely low historically, guys. Here's a couple, here's just the brackets for a couple filing jointly. Okay. So let's talk about some tax deductions, right? So most of you probably know that if you're married, filing jointly, you automatically get a standard deduction of 24.8. For single filers, 12.4. Alternative itemized deductions on the Schedule E. So mortgage interest on debt up to $750,000. Okay. Charitable gifts, of course, of cash check or up to 60% of income. State and local property tax up to $10,000. There are some additional tax deductions of 65 plus or blind folks. So what we're trying to emphasize here is that, you know, it's harder to itemize, right? So in the past, you've been able to itemize and reduce those taxes. Now you're getting that great big standard deduction, which is great, but that could go away very easily. The Tax Reform Act was put in place till 2025 and it sunsets. So no matter who's in office in the presidency, whether it would be Trump or Biden, they're gonna the taxes are gonna go up, folks. There's just no doubt about it. Okay. Capital gains, like this is we're at an all-time low. It's a huge opportunity right now to sell capital, appreciated assets, okay, and make those transitions to Roths and whatnot, and IUL, so you can safe harbor your money for with tax-free strategies, so you don't have to worry about taxation. So capital gains taxes, even on the wealthiest, the top capital gains is only 20%. Historically, it's been as high as 40–50%, right? So once again, just taxes are on sale. I feel as though taxes will go up in the future a great deal. Did we get anybody kind of fire back at us as to what they thought were going to happen to taxes, Brendan?
Most people just agreed that they're going to increase.
Okay, all right. So we're in agreement out there, so that's the one thing we have to plan for, folks, is how do we combat that silent killer and how do we avoid taxation as best we can. And so just so you know, our practice throughout the Tampa Bay area, we do Zoom meetings, we can do in-person meetings, we can come to you, we have office locations everywhere, whatever you're comfortable with, but we are also a CPA firm. So we have a CPA on staff, and our CPA has been doing taxes for over 30 years, okay? So we look at everything through the total spectrum, and we look at everything from really a tax saving standpoint, a risk standpoint, and also reducing fees. So let's talk about which type of investing do you like most, okay? So you have a couple of different strategies that you can tackle or go at when you're kind of investing for your retirement. One is you don't have to be in the market at all, okay? So you can grow a safety, you can still have some market upside, right? Limited to no downside. Your principal is 100% protected. We have strategies that have zero cost to them. Typically, you want to maintain these for 7 to 10 years, and you can earn up to 5 to 7%. And some of them even have options for guaranteed income. Okay, so we call this investing in a smart financial plan. So let's look at a market passive investment. So a market passive investment, or a passive investing, is kind of like you buy some mutual funds and you get a bunch of mutual funds in your portfolio and just kind of buy them and hold them. This strategy can work absolutely long term for folks that have a lot of time. I met with a gentleman the other day. He's 83 years old. He put about $400,000. He retired at 55. He put about $400,000 in his IRA. He stuck it in one growth fund and never changed it for over 30 years. He actually withdrew like 500 grand from it, and over his lifetime, and he still has about 500,000 in the portfolio, and never changed anything. He went up and down with the markets and all that kind of stuff, and that was okay. That happened to work for him because he didn't need to pull a lot of income off of the portfolio. He had pensions and other things to live on. But a passive portfolio is what 99% of all of you are doing out there. And so you're gonna passive investing, you're always gonna get 100% of the market gains, which is great when the market's going up, but you're also gonna get all the losses, which is not so good now that you're getting closer to retirement or even in retirement, right? Usually there's about a 1% fee on that type of money management. Even if you don't see it internally in the mutual funds, there's definitely a fee, a percentage. So typically when you invest in these type of investments, you want to have a horizon of 10 to 30 years. So in 2008, we saw that strategy was down 38%, right? So, and then it certainly bounced back 2009, but it took about 10 years to get that money back. So think about it, while we're young and you're working and you're in the accumulation phase, you just work and you're putting money away. That's not as important, right? But now as you're close to retirement or even in retirement, if you start pulling money out and you get these market losses, it can be devastating. And mostly in those first 5 years of retirement. And I can show you guys on a chart later on. If you want to set up a consultation with me, I'll show you actually on a chart how that works, okay? It can be really, really devastating in the beginning years. So just kind of formalizing this example in real dollars, right? So if you had 100,000 and you lost 38%, you're down to 762,000 in 08. So will there be another 08? I certainly hope not, but we saw during the pandemic in March, I think the market crashed, 30 something percent in 1 month. So we got lucky that it did kind of rebound and has had some rolling recovery, but we still have a long way to go because the only sector that really recovered was technology. The rest of the broad market still has a long way to go to recover. So we like what we call investing in a smart plan, and that's more of a tactical plan. We like tactical investing. And how that works is you're going to get about 70% of the market gains, right? But only about 40% of the market losses. So we're kind of narrowing the band and the range of returns, but we're lowering the volatility. And so we're tightening that margin of predictability. So higher cost, of course, there's about a 1.5% annual fee for tactical investing because they're actively managing your portfolio every day. It's not just sitting there and no one's doing with it. This is being actively managed every day with algorithms and models, and it's predicting future outcomes and potentially if there's some market downturns that can move to the sidelines or reduce allocations. And so tactical investing is what we call active money management. And I absolutely firmly believe that 100% going forward, especially if you're a retiree, folks have to get into this tactical style. Same thing, long-term time horizon. You want to have a time horizon around 6 to 8 years. But as an example, in 08, portfolio goes down 38% in a passive investment. If you were in a tactical, you might have only lost 16%, right? In 2009, even when the market came back, instead of getting all the upside, you would have gotten still about 70% of the upside, right? So how does that look? So compared to the previous slide, losing less money is much better, right? So only at 962 there as opposed to the previous slide was 700,000 or so. So very important to read. It's very important, especially in retirement, that we're not trying to hit home runs on the upside. It's long-term success, okay, is more about not losing money in the down years, okay? And so I'm going to ask you guys to chime in here again and just tell me what you think going forward over the next 10 years. Do you think it's going to be like the previous 10 years where we kind of have the market kind of slowly increase and recover now that we're at a really expensive high point? I really don't believe the next 10 years is going to be anything like the previous 10 years. I think we're going to have some sizable market corrections. In fact, I listened to all the big experts out there, and one of the guys who runs Vanguard funds, he had his analysts do a long-term projection, a balanced portfolio. They feel as though after fees and expenses, which is a moderate portfolio, might make 3% over the next 10 years on average, okay? So that's probably not going to cut it for us. And that's because there's a big drag on the bonds and everything else as well, okay? So you guys can certainly get your complimentary portfolio analysis and think about it. If we're reducing your fees, sometimes cutting them to zero, reducing your downside and reducing your risk and increasing tax efficiency, I can show you on a long-term projection over 10, 20, 30-year retirement report that we're saving people hundreds of thousands of dollars just by making these simple changes, okay? How many of you out there have bonds in your portfolio? You guys can kind of chime in and let me know. Do you know when, and if you do have bonds, you know when they retire, what the what the maturity dates are there inside of there? So if you have no idea to those questions, we might be able to help you guys out and do an analysis, so you can an analysis, so you actually know how much bond exposure you have inside your portfolio. Okay. I mean, bonds are at all-time low interest rates. Did you know that the stock market is trading at about 22 times earnings right now, which is historically not too bad. It's a pretty fair value. Bonds are trading at 135 times future earnings. So think about that. Bonds are extremely expensive, extremely volatile. Interest rate, and you don't even get anything in your portfolio for holding them. So we've got to look at alternatives and different strategies to eliminate that that drag. Okay. This is just that rule 100. I kind of like rule 110 actually, but rule 100, you know, if you take 100, subtract your age, that's about the percent you should have in your portfolio. This was kind of an old rule, risk reward rule. I kind of like 110. If you take 110 and subtract 60, you're at 50%, just because, you know, the bond market is just basically, you know, it's just not a great place to have money. So you can pick up more dividend and interest just being in the stock market. And that's another reason why we've had kind of false upward movement of the market. It's being hyperinflated because there's no place for people to put their money. You're not going to buy bonds right now, so it's forcing people to go into the stock market to try to pick up some dividends. I think I saw Pfizer stock, right? It has almost a 4% dividend right now. So why would you own a 10-year treasury paying like 1%, 1.5% when you could own Pfizer? But however, that Pfizer stock has some risk, right? But I think we have to have a little bit more stock allocation right now than we do bonds and fixed income. So smart plan equals smart risk plus smart safe, right? So smart risk, like we said, is that tactical portfolio. Safe money, you can utilize potentially fixed indexed annuities. And we believe a successful portfolio is a combination thereof, okay? And kind of replacing the bonds that you may have in your portfolio with an indexed annuity. So this is a big common question that I always get in my practice. I also help manage 401k accounts for corporations. And a lot of these offerings inside 401ks have target date funds, and you all may have a target date fund. They're very popular just because it's an easy choice. It was the way the industry could kind of make things easier for you to choose. Unfortunately, it's kind of crazy. Like, you know, you're working and you might be a, I don't know, you could be a doctor, you know, and you have a 401k plan and you don't really know anything about stocks and investing. I mean, this is what we do every day. That's our discipline. But they expect you to pick your own stocks, right? Your own mutual funds. How do you do that? So what they have done is they've created these target date funds just to make it easier. We're not big fans of them. I'll show you why. But most all companies out there have their own target date funds. How many of you guys out there have target date funds? I'd love to hear from you. Raise your hand or pump it in the chat there. But there's two real critical flaws with these. And the reason that I put this in this presentation is just, I feel like there's just way too much exposure to this right now. And this is, you know, not the right environment. In fact, these were created like a long time ago and they're just not as relevant today. I just don't like them at all. And let's think about, so let's look at this, you know, this graph shows, you know, flows in the first 3 months of 2020, right? So you had, you know, massive outflows during the March sell-off of the pandemic. So if you're sitting in a target date fund, but people are selling it like, you know, like crazy, you're losing value. Your price of your funds going down. You have no control of it, right? And investors who are as far as 15 years from retirement actually started pulling money out of their target date funds because they were kind of in a panic or they were scared about the markets. That hurts you guys. That hurts the funds. You have no control of the inflows and the outflows and the prices of those mutual funds. Okay, it's a supply and demand pricing structure with those. Okay, and then here's the number one reason we don't like it. This is called the glide path or allocation of stock. So if you're in a target date fund, and let's say you're retiring in 2030, and so you pick the 2030 target date fund, as you get closer to your retirement, they're putting more money in bonds. So if you're out there right now sitting in a target date fund and they're adding bonds to your portfolio currently at the very, very, very wrong time, okay? At the worst time to be adding bonds. And in fact, you could find yourself at some point where bonds would dominate your portfolio because, you know, it forces investors to sell stocks and buy bonds at very low interest rates currently. I mean, we're at historical rock bottom low interest rates. So absolutely the worst strategy that you have no control over, okay? That's just, this chart just shows you those forward bond returns that I talked about earlier. The key to take away from here is that, you know, stocks are priced at about 22 times earnings and bonds have a PE of 135, okay? And you got to remember that forward returns are linked directly to the current interest rates, and we're currently looking to be much below that and probably stay there for a long, long time, okay? So should you consider target date forward returns? Significant growth difference in 401ks versus the 401k managed IRA, right? Results here are nearly doubled, okay? All right, great. My favorite subject, let's talk about Roth IRAs, one of the most underutilized tools, okay? So the Roth IRA, how many folks out there have a Roth? All right, great. We're getting a few folks chiming in there. Appreciate that. So a few people out there with Roths, great. I like to see that, but I'd like to see a lot more. We definitely have to have more Roth out there. And unfortunately, you know, a lot of people just didn't understand them. There wasn't a lot of education. They weren't offering it in 401k plans. But if you wanted to set up a Roth, it's never too late. Contribution limits, 6,000 per person. There's also a catch-up provision if you're 50 or over, right? Your contributions are not tax deductible. You can contribute for a non-working spouse. Your principal is liquid from day one. Your growth is tax-free, right? And then the beauty of it is later on when you want to take money out, those distributions are tax-free, right? And you got to make sure, this is a common mistake to avoid penalties on the growth. The 5-year rule applies, which means if you do a Roth conversion or you set up a Roth, you have to wait 5 years before you start withdrawing money from that. So that's why I say, if you're out there listening, let's get started on this conversion. The great thing about the law change is that there's no restrictions on income limits. Everybody can do a Roth conversion now. And when I say Roth conversion, I'm talking about actually taking a lump sum of money out of your 401k or IRA, rolling it to a Roth, paying those taxes on that entire sum, and then letting that grow for future earnings, right? So I'm really encouraged. A lot of my clients and a lot of folks that I've been working with are really starting to grasp this, and they see that taxes are on sale currently, and they're becoming real active with this Roth strategy. We create a whole ladder for you. We look at your taxes, your income, and we'll slowly structure this over time for you, or we could do it all in 1 year. It just depends. Everybody's different. But you got to start moving towards this tax-free strategy, okay? So these are just some more examples, like married filing jointly phase out begins at 196 and ends at 206. So no required minimum distributions during lifetime. This is pretty cool. Think about that for a second. If you're in a regular IRA, a traditional IRA, and you have to, at age 72, they demand you have to start taking money out so we can tax you, okay? If it's in a Roth, that's eliminated. You don't have to take money out of your Roth. You can continue to let that grow tax-free, okay? And then pass that to your heirs tax-free, okay? If you pass it to your heirs in an IRA, it's gonna be taxed at that current tax rate, whatever it may be in the future. Could be as high as 50, 60%, who knows? I don't know, okay? But you get to decide when you want to take distributions. That's hugely powerful. You gain control there and take that control away from the IRS, okay? I love that. Gives me goosebumps, okay? Allow your account to grow uninterrupted tax-free for life, and can, of course, provide those tax-free inheritance to heirs. Love that stuff. We got to get that going, guys. So conversion rules, once again, new laws passed, no income limits, right, on or phase out, which is awesome. It used to be where folks would get phased out based on being high earners. And so we need to take advantage of that. They could change that law, right? They could change that in the near future. So obviously they may increase the effective tax rates. There's no age limit to convert. Personal tax advantages, no income taxes due on the future earnings or withdrawals, and does not count towards tax on Social Security. Let me say that again, folks, does not count towards tax on your Social Security. So if you're just stick with the status quo and you're fine-tuned into conventional wisdom and you just keep your money in an IRA or 401k, that money, when you start taking it out, does go to your bottom line in your tax calculation and will cause your Social Security to get taxed. This does not, okay? So if you don't want your benefit to be taxed and you want to keep all your Social Security, let's look at this stuff, guys, okay? So this is just talking about what I talked about earlier. We do that Roth conversion ladder for you. Everybody's different. Everybody's time frame is different, but we can get that ladder going for you guys, which is, like I said, dramatically going to reduce your taxes, dramatically going to reduce your fees, and dramatically reduce your risk, okay? Well, and just a little bit of planning, guys. Don't have to be fearful of making massive changes, okay? So in the past, you've been able to convert to a traditional IRA, right? And be under, but you had to be, your income had to be under $100,000. And so that's where this big benefit is now that they've removed that cap. So that's huge for us, guys, huge. Now's the time to do this stuff, I'm telling you. This is just a great example of a client that we did this for. I just wanted to kind of illustrate this for you guys. These folks, had about 760,000 in an IRA, made about 166,000 in income, and decided that the Roth conversion was what they wanted to do. And so when we did the projections and we started doing this planning for them, $834,000 down to 356 for a tax savings of 478,000 over a 30-year time frame. So total retirement inheritance and tax saving was over $718,000, guys. Okay, so when you factor in, we got to think long term. I'm trying to get people to not just think about the immediate future. Let's do some projections. Let's look out 10 years, 20 years, 30 years. We're living much longer in retirement, guys. We're retiring early. This COVID-19 has forced a lot of folks to retire early. I've gotten that phone call from folks that weren't going to retire maybe for 5 years, and they said, "Hey, I'm retiring now." COVID has kind of forced me in that direction, right? So you got to get started on this planning. But this is a great example of the savings and the balance of the Roth long term. Okay. Once again, if you guys are interested in just doing that Roth conversion ladder, 100% free for you guys, okay? So just pop into my Calendly right now if you like. Brendan's kind of operating that for me, and you guys can set up an appointment right now and get on my calendar. It's important if you guys want to start talking about this stuff. My appointments, I do stay pretty busy, pretty active. My calendar fills up pretty quick. And we're looking at maybe a 15-20 minute introduction call with you guys. And then we can dive more into your specific needs. And what a great opportunity to take advantage of that, done for free for you guys, okay? This is just an interesting, one of my good friends and colleagues up in Atlanta who helped me design this presentation. He actually had Mr. Collins on his radio show this morning, actually. And, one of his quotes we just put on there, the only way Roth IRA rules change is if we get all Democratic government. And so, obviously Democrats are in favor of higher tax rates, right? So more than likely, all the Roth rules could change as well. So let's get it going. So we're grandfathered in there, okay? So one of the other things that I talked about what the wealthy do earlier, and then my example was utilizing what is called an IUL. And when I say what the wealthy do, I just mean that this is what tax savvy kind of wealthy people with planners and wealth management planners have been doing for a long time. You guys out there might not know anything about it, and you don't have to be wealthy to do it. I just helped a gentleman do this last week. He was 52 years old. I had an additional like $25,000 of income per year that he wanted to put away for retirement. And he wanted to retire at age 67. So we had 15 years, right? But I showed him with utilizing an IUL, you could put that extra income every year for 10 years. He would have invested 250,000 into that for 10 years. That at age 67, that was going to create a $45,000 a year tax-free income for him, plus provide a $550,000 death benefit for his wife. So just goes to show you that you don't have to be wealthy even to get something like that started. Plan ahead, plan ahead. Maybe you guys have some young kids out there, or folks that friends, family, neighbors. It does not matter what age they are. We really need to start looking at Roth and IUL policies. Okay. So how's an IUL work? Features and benefits are pretty cool. You get some guaranteed benefits. Your premiums are flexible. You have a potential for high interest earnings without market risk. So they have market-like returns with no risk. You can't lose your principal. So option to borrow later on in life, right? So what you do later on in retirement, if you want to take money out, it's a tax-free loan that you don't have to pay back. It just reduces the death benefit later on. But your money's still growing at a market-like return. Think about that for a second. Your money's still growing 6-7%, right? With no potential principal loss. And you can take that money out tax-free in retirement. Okay. And grows tax-free as you're going, and passes to your heirs tax-free. Okay. So hugely impactful. Some of the drawbacks, earnings depend on the index performance. So the way that they manage these is none of your money is invested in the markets. They actually take your money, the insurance companies, invested in US Treasuries, which is 100% safe. US Treasury, the safest investment out there. It spits off interest. They take that interest and they just buy options on the market, guys. They don't put your money in the market. So if the markets do well, they credit your account. If the markets do poorly, your account stays the same. And also every year, once you get interest, it locks that in, right? And never goes backwards. So hugely impactful long-term for you guys. Once again, focusing on maintaining risk, avoiding market losses, basically no fees on these, and also reducing those taxes, okay? The silent killers of retirement. So once again, that 4% rule, we really wanted to kind of just reiterate that. This is the amount of money you might withdraw each year from the starting value of your portfolio, right? So experts consider that 4% withdrawal rate to be safe for withdrawals, but you should consider interest and dividends. But keep in mind, if you're just in that traditional moderate portfolio, you've been kind of lied to, like, hey, this is a safe investment, and you're kind of hedging your risk against the market. Wall Street wants you to think that, but that's not true. It's not risk. It's not risk. You're not lowering your risk. And in fact, what I talked about earlier is that most of your experts and even Vanguard and these analysts that have looked at these portfolios long term and kind of projected their values, you're looking at about a 3.5% rate of return after fees. So you're not even going to keep up with the 4% rule. We've got to keep up with that at least, guys. So one way that we reduce the risk in your portfolio, some of you may or may have not heard this term, is called standard deviation. We look closely at the standard deviation of your portfolio, and that's how we measure the risk in your portfolio. We'll pull that out in our analysis and we'll show you, here's your standard deviation. What does that mean? Your portfolio that you currently have, or your current plan, has an average annual return, and then it also predicts what the average annual return will be that going forward. And if you have a portfolio of a standard deviation of 10, but your average return is 5, you're seeing, you could be as high as 15% one year, or you could be down -5%. So the standard deviation is the measure of that volatility away from the mean over time. So if your portfolio is doing this, that means you have a lot of risk in the portfolio. We need to shore that up and kind of reduce that for you guys as best we can, okay? So one thing, we're kind of wrapping up. I don't know what time it is. It's what time are we at here? Oh, 11:29. So have we really been doing this for an hour? That's crazy. I can't believe it. I'm having too much fun. Is everybody still out there, or do we lose everybody? I mean,
We actually have more people.
That's incredible. So I felt like I just talked for 5 minutes. So that's kind of how passionate we are about this. But my team is going to get a hold of you guys if you're interested in kind of talking about some of this stuff and doing a Zoom meeting, whatever you want to do. That's great. I hope we didn't have like a difference in time change, because it looks like everybody's coming in at 11:30 instead of 10:30. So anyways, but my team's going to contact you guys. We're giving out free gift cards just as a thank you for attending today. And hopefully you can make an appointment and make sure that we get things going for you guys. Okay. So just as a little summary, what have we learned today, right? And was it helpful? So we learned how to save up to $782,000 in taxes with your Roth IRA, right? As an example of one of the examples we use, we save up to $250,000 in fees. We kind of talked about some top 3 strategies to eliminate or reduce your taxes dramatically. How to generate some income, how to get extra Social Security, right? Increase your Social Security, how to avoid those penalties, and then how that Secure Act protects you, and so much more. So if you want to find all of your opportunities to save taxes and increase your net worth, please give us a call. Click on that link. Visit our website, takepointwealthmanagement.com. You can get us there. You can call us. I think our team is going to follow up with you guys, but you can also book your appointments right in the chat group, and we can do everything over Zoom. It's kind of fun, and work with you guys that way. That's however you guys are comfortable. Okay. But that's kind of it. Once again, just kind of making your portfolio more efficient, market efficient, fee efficient, and tax efficient. We're going to get to a couple of questions. Go ahead, Brennan.
We had a question. Someone asked, I thought that the income had to be from earnings, so the spouse can still have a Roth IRA, even though she may be a non-working.
So that's a real specific question. I thank you for that question. And it's very long-winded answer, but yes, you still have to have earnings in order to contribute. Absolutely. But that has nothing to do with Roth conversion and whatnot. But it sounds to me like you have a very specific question with a specific answer that we can dial in for you. And I'd be happy to get that to you for you. Just go ahead and visit with me for about 15 minutes on my calendar. Okay.
And a lot of questions came in during the Roth IRA portion.
Sure.
So
yeah.
Another one came in. Someone asked, like, they were confused. Is there an income max of 196K?
Is there an income max of 196K? Yeah, whatever that table was, absolutely. So that's just for the contributions, right? You get phased out if you want to start an IRA and contribute. If you already have money in an IRA 401k, it's unlimited. There's no cap. We can start doing those Roth conversions for you. Okay.
And one more here. So should I take out all my IRAs, get it taxed, and then move it to a Roth?
So that's a great question, right? It really depends on all your other income sources. And that's why the planning is important for you to go through with us and let us look at that for you. So it may be some people can do that all in 1 year, it depends on how much you have too. Like, obviously if you have $1 million, you don't want to pay tax on $1 million all in one shot. If you have 50,000 and you want to do that all in one shot, and depending on what your income level, that might not be as impactful, but it has to depend on, your income, what your deductions are and all that. And we do that free tax analysis for you, absolutely free. So great question. I see another one here from Jim, looks like. Are you a fiduciary? So yes, absolutely, we're a fiduciary. Great question. That kind of gets thrown out a lot out there in the investment marketing world, but we are a fiduciary, which means that we have to put your interests first, and we're held to a very high compliance standard. We don't earn commissions and churn account. We only get paid based on the performance and the value portfolio. So if your portfolio goes up, our fee goes up. Portfolio goes down, our fee goes down. we are on the same side of the table with you, and our goal is to grow your money, right? So we are 100% a fiduciary, so that's a great question. I appreciate that. If I wanted to set up a meeting, what do I do? Okay, so hopefully we made that kind of clear during the presentation. You could click in my calendar. We're also going to have a team that's going to follow up with you guys to get you on my calendar if you want. And we can do that via Zoom. Obviously, people are more and more concerned about COVID. I understand that. I can meet with you personally. We can social distance. You can meet at one of my offices, or we can just do a phone call just to get to know each other. Okay, absolutely no problem. One more, what are your fees? So great question, right? So we don't charge anything at all. Because you guys joined us today and came to this Zoom meeting, your consultation is 100% free. We just ask that you engage and really work with us to try to improve your situation. If you engage and give us all the data that we need, I know that I can dramatically affect your retirement going forward. There's no cost to that. Now, if you should decide that you like what we say and like what we do and you want to work with us, then that's a different story. We're paid a couple of different ways, and I'm just specific about it, right? If we did a market-like portfolio, like that smart risk portfolio I showed you, a tactical portfolio, it costs you about 1% annually on your market value. If we did an insurance type product, you don't pay us a dime. You don't pay the insurance company a dime. There's no fees, no expenses. What happens there, guys, is the insurance companies pay our firm a commission, okay? And so nothing comes out of your pocket. So great questions, guys. Man, I've had a lot of fun. This has been my first one. Hopefully it came out great. Give us your feedback. I hope to do a lot more of these. Like I said, I'm used to standing up and talking to you guys and having a good time, laughing and joking. So this is a little weird, but this is just the times that we're in. And hopefully you guys enjoyed this webinar. And I've seen a lot of people come in late, which is a little concerning. I think maybe the time might have been wrong. But if you're coming in, then we'll get you this whole presentation, and go ahead and set up an appointment with me, and I'll do the whole presentation for you. I don't care, okay? But it looks like we're getting a lot of participants here at the wrong time. This started at 10:30 Eastern, and it's now 11:30. Is that what's happening, Brendan?
We only gained one person. So
Okay.
I imagine just one or two people came.
All right, great. So that's it, guys. Keep mindful of your time. I know it was a lot of stuff. I can't believe it was an hour long. I know it was a lot of stuff and we breezed through it, but this is just a great opportunity for you guys to get with a professional. I've been doing this 22 years. My partner's a CPA 30 years, and no obligation, no fees, we're not going to put a gun to your head and try to sell you anything. We're truly passionate about trying to help you guys get you to and through retirement. And number one, if I can't lower your taxes, if I can't lower your fees, and I can't lower your risk, then there's no value there. So that's my focus, and I know I can do that for you guys. So once again, been exciting. I hope to see you guys or speak to you guys real soon. And that's the end of the meeting. So I think we just button up and close up. You guys have a great weekend. The weather's nice. Enjoy.